We all need to make smart decisions with our money. The Long-Term Investor Podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
While people tend to focus most of their attention on the stock portion of their portfolios, having a firm grasp of the underlying fundamentals in your bond portfolio is really important too. Yields have been exceptionally low for quite some time, and if there's one thing I've learned about how investors react to their bond holdings, it's that the biggest mistakes tend to be made when yields are at their lowest. So if you've been questioning your own bond holdings lately, covering the basics can help you feel more confident in this part of your portfolio and also provide context to the questions you might have around things like rising interest rates. Let's start with how you measure return on your bond portfolio. The total return you earn by holding a bond until it matures is measured by yield to maturity. That's simply the sum of all interest payments you receive until maturity, as well as any gain or loss of principal. For example, consider a bond with the following characteristics: 10-year term, $1,000 face value, and $80 in annual interest payments. If you bought this bond at par, meaning you paid the face value of $1,000, then the yield to maturity is 8%. If you bought the same bond at a discount of $900, then the yield to maturity is 9.6%. The increase in return results from buying the bond below its stated face value. And this works the other way too. If you buy a bond at a premium of $1,100, then the yield to maturity is 6.6%. The decrease in return here results from buying the bond above its stated face value. Now, once you buy a bond, like any other asset, the price changes. With individual bonds, you might not see that change unless you're putting your bond up for bid every day, but the price and expected return of a bond is constantly changing. Bonds experience price volatility in response to a lot of different factors, but the most prevalent is changes in market interest rates. As market interest rates rise, the prices of outstanding bonds with lower rates fall. Conversely, as interest rates fall, prices of outstanding bonds will rise until their yield matches that of the new bonds issued at the current rate. And this relationship can be illustrated using a simplified yield calculation that I'll be sure to drop into the show notes, just because sometimes it's easier to digest numbers when you're reading them instead of listening to them. And for all you bond experts out there, do note that this example is using current yield rather than yield to maturity, just for the sake of simplicity. So, let's say you own a $1,000 bond with an annual interest payment of $80. Your current yield is 8% because $80 divided by 1,000 is 8%. If market interest rates rise to 9%, your bond decreases to roughly $888 because 80 divided by 888 is 9%. If interest rates fall to 7%, the price of your bond increases to $1,142. $80, the annual interest payment, divided by that $1,142 is 7%. In real life, changes in interest rates don't affect all bonds equally. Duration measures how sensitive a bond's price is to changes in interest rates, and higher duration bonds experience bigger gains and losses in response to a change in interest rates. Although rising rates result in immediate bond price declines, long-term returns are actually enhanced due to the ability to reinvest at higher rates. Understanding the math behind this concept is really important, but I've come to learn that some people have to see it visually for it to sink in, so I'll be sure to add a chart to the show notes for the example I'm about to share. Imagine a scenario in which there's a one-time shift in yields across the entire bond market of 1 percentage point. In this analysis, which again you can find in the show notes at thelongterminvestor.com, I pretend that there's a bond with the same starting yield and duration as the Bloomberg Barclays U.S. Aggregate Bond Index, which is a total market bond index that's commonly used in the finance profession. If you happen to check out the chart, you'll notice that this one-time parallel shift in yields of 1 percentage point and then no further fluctuations in interest rates would result in a loss of 4.5% in year one. But the loss shrinks by year two as interest and principal is reinvested at higher rates. And by year three, the cumulative return turns positive, and over time, the cumulative return grows even more as the benefit of higher rates compound. Part of that's because I'm assuming that all income received is reinvested because, one, it's a realistic assumption, and two, it's an important part of the math here because reinvesting income at higher rates helps offset the losses in the initial hike year and increases the total return of the bond portfolio over time. The purpose of this example is to say that even though interest rates have been rising in the past year, that's not a good reason to abandon your long-term allocation. When rates rise, bonds will eventually provide nominal returns equal to their yield over a time period equal to their duration. The fear of rising interest rates is probably the most common question and concern I get about bond holdings, but a close second is related to how you can earn more on your bond portfolio. Relative returns are largely driven by the term and credit quality of a bond. Longer-term bonds experience bigger price movements for a given change in interest rates, and as a result, investors expect to be compensated for taking that extra risk. I'll drop a table into the show notes where you can see historical returns across different bond terms, and you can see these 20-plus year bonds have historically earned about half a percentage point more than the 5-year bonds, but with roughly double the volatility. This extra return being earned is referred to as the term premium. Although longer-term bonds offer higher yields and returns, my opinion is that they rarely offer enough of a return premium to justify the higher risk when compared to shorter-term bonds. So term is one of the major drivers of bond returns. The other is credit risk. By loaning a money to a company with lower credit quality, investors face a higher risk of not receiving all of the promised interest and principal payments. In addition, lower-rated bonds tend to drop more in value when the economy slows because recessions lead to lower profits and increase the likelihood of default. Consequently, investors require a higher yield to compensate for taking this extra risk. The relationship between fixed income credit risk and historical returns has been pretty consistent. Taking additional credit risk by lending to lower-quality companies produces higher returns and higher volatility. And again, I'll make sure to share data in the show notes at thelongterminvestor.com. But using the historical data set that I'm looking at, you'll see that much like our example with term risk, credit risk is only beneficial to a certain point. For example, junk bond returns are higher than BBB bonds, but they come with 73% greater volatility. Not exactly something you want to see in the portion of your portfolio that's supposed to be dedicated to safety. Now that we've laid the foundation for how bond returns are measured, as well as the drivers of that return, I'd like to turn my attention to one of the biggest misconceptions that I've seen throughout my career, and that is the value of individual bonds versus bond funds. Investors who hold individual bonds tend to believe that the implications of interest rate fluctuations don't impact them because they'll receive their principal value on an individual bond if it's held to maturity. And similarly, some people perceive bond funds to be riskier since they never mature and fluctuate in price every day. While it's true that holding an individual bond to maturity will result in the return of principal, assuming the bond issuer doesn't default, those nominal dollars are going to be worth less with inflation and during periods of higher interest rates. Additionally, the lack of price volatility in individual bonds is largely an illusion. Individual bond prices fluctuate every day, even if held to maturity, but you may not notice if the bond isn't repriced every day. And finally, individual bonds mature, and most bond funds do not. But most individual bonds are part of a bond portfolio that never matures, as investors usually reinvest the proceeds of maturing bonds into new bonds. So in other words, a portfolio of individual bonds is actually a form of a bond fund, but with 4 distinct disadvantages. The first is that individual bonds often are higher cost. Now, if you think your individual bond portfolio is free, think again. The cost of an individual bond is hidden, and it's very difficult to measure since it's baked into the purchase price and yield. Rather than charging investors a commission to purchase a bond, a broker-dealer sells you the bond at a markup, and these markups can be as high as 5% of the bond's original value. A 2015 study published by Lawrence Harris, former chief economist at the Securities and Exchange Commission, estimated that the average transaction cost for retail-sized trades is 85 basis points, or 0.85%. Unfortunately, the bond market isn't a level playing field. Most investors, and even many financial advisors, don't have the tools to know whether a bond is competitively priced at the time of purchase. Investment fees matter regardless of asset class, but in a low return area such as bonds, it's arguably even more important. So even though you might think your individual bond portfolio is costless, it's typically far more expensive than owning a bond fund. A second disadvantage of individual bonds is that they can create an unnecessary cash drag in your portfolio. Cash drag is the opportunity cost of not being able to reinvest interest and principal on individual bonds in an efficient manner. Let's say you own a $100,000 corporate bond yielding 2.5% with interest payments made twice a year. So every 6 months, that bond will generate $1,250 in interest. If this interest is supposed to be a part of your fixed income allocation, you won't be able to purchase another individual bond in that small of an increment. And as a result, you're likely to have the interest sit in cash earning next to nothing, hence the term cash drag. A bond fund, on the other hand, holds thousands of bonds with different yields, maturities, and durations. And this means that managers can reinvest bond proceeds into new bonds on a daily basis at current market rates. This eliminates cash drag and allows bonds to better benefit from fluctuating interest rates because they act as a daily dollar cost averaging mechanism. This is particularly important in a rising rate environment, as bond managers are able to more efficiently reinvest proceeds from their bond portfolios into new bonds with higher rates of return. A third disadvantage of individual bonds is if you invest in individual anything, there's a lack of diversification. Basic financial theory tells us that risk and return are related, which implies that investors should be compensated for taking additional risk. Individual bond portfolios are frequently exposed to concentrated position risk, also known as unsystematic or idiosyncratic risk, while providing no additional compensation to investors for that risk. This risk can easily be avoided, though, through cheap diversification that bond funds provide. For example, the Vanguard Total Bond Market, the ETF ticker being BND, holds nearly 19,000 positions with a rock-bottom expense ratio of 0.04%. And broad diversification isn't just about number of holdings. A properly diversified bond portfolio should use funds that contain securities with a variety of interest rates, durations, credit qualities, geographies, etc. In my opinion, it requires at least a $10 million fixed income allocation to begin properly diversifying a portfolio of individual bonds in a cost-efficient manner. But even then, you can achieve much better diversification by utilizing bond funds, particularly when you start thinking about global exposure. And as I go to this final disadvantage of individual bonds, without bond funds, you might miss out on global exposure. Investors shouldn't limit themselves to just the US bond market. Global fixed income is one of the biggest investable asset classes and a tremendous source of diversification. And yet, this is an area where investors are routinely underexposed. Using global bonds with hedged currency exposure has historically provided a dramatic reduction in volatility, and that's because each country's yield curve is shaped differently, and the factors that impact change in yields are lowly correlated across countries. Another reason for the reduction in volatility is that global bonds add to the number of issuers in a portfolio and thus diversifies among different credit risks. Not only would it be challenging to sufficiently diversify across a variety of countries using individual bonds, the currency hedges required to capture the diversification benefit of this asset class are very costly and complicated propositions for an individual bondholder. Bonds play a really important role of reducing your portfolio's overall volatility, but historically low interest rates make the disadvantages of individual bonds versus bond funds even more prevalent. Investors using individual bonds for their fixed income allocation would be well served to reconsider their outdated strategy. One final thought that perhaps I should have kicked off the episode with: the primary purpose of your bond allocation is to decrease the overall volatility of your portfolio, not to earn the biggest return possible. When you start reaching for additional return in this part of your portfolio, you start taking on substantially more risk, really in an area of the portfolio that's supposed to reduce risk. And just like stock market movements are impossible to predict, bond market fluctuations, although they're nowhere near as severe as the stock market fluctuations, these bond market fluctuations are impossible to predict too. Rather than trying to predict the movements in interest rates or the bond market, you should really be focused on things that you can control in this portion of your portfolio, such as costs, our exposures to term and credit risks, and diversification. As always, thank you for listening, and until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.